Hello, ladies and gentlemen. I hope you are fine and you are enjoying our video series. All right, and we are going further in our investment appraisal lecture series. And in this particular video, we are going to dedicate all our energy on the aspect of taxation. All right, taxation is going to come in our examination, and we have to know how to treat taxation when it comes to net present value computations. Now, there are two aspects related to taxation we have to worry about. The first aspect is that related to the operating activities. Okay, when you do whatever operation you do, when you make profit, the taxman is going to charge some tax on that, and that the tax on those aspects is going to be determined by the level of the tax rate in that particular year or in that jurisdiction. So that's tax on income or taxable income. So you will be charged there. Then there is also an issue related to capital investment. When you purchase an item, let's say a machinery, the taxman usually encourages investors to invest in their jurisdiction, so they will allow you to do what is called tax allowable depreciation. So there is also a benefit, a tax benefit from investing in capital assets. So that's the second issue, the issue of tax allowable depreciation benefit. Okay, so this example is going to illustrate to you on how to do the computations. So please watch and listen carefully. We have got Boswell Core, which is a year end of 31st December. It is considering the purchase of a new machine on 1st January 2023 at a cost of $10,000. The machine is expected to generate net operating cash flows of $5,000 during the first year, $7,000 during the second year, and $8,000 during the third year. It is intended to sell the machine at the end of the third year for $6,000. Additional working capital of $1,000 will be required at the start of the project. Corporation tax is 30% payable 1 year in arrears. So please be careful. This tax payable either 1 year in arrears or in advance, you need to be able to attend to those aspects. But usually in our exam for the financial management, it's usually in arrears. Okay, capital allowances are available at 25% per annum on a reducing balance method or basis. Okay, the capital allowance here is the rate of the tax allowable depreciation. All right, but when we are talking of the benefit on the tax allowable depreciation, we will be then have to put into perspective the 30%. Okay, the cost of capital is 10%. Calculate the net present value of the project and advise as to whether it should be accepted or rejected. So let us get straight to our spreadsheet and see what we need to do. The first thing, we need to calculate the tax allowable depreciation, okay, including the tax benefit or tax saving. All right, tax allowable depreciation is not the tax saving. You need then to determine the tax saving, because the tax saving is the relevant cash flow. Depreciation on its own is not relevant, but the tax benefit is the relevant cash flow. So we come to our spreadsheets. All right, let us consult our spreadsheet. Let's open a new one. Okay, now this is the spreadsheet, ladies and gentlemen, and let's first determine the capital allowance. Capital allowances, capital allowance computations. All right. In the exam, don't worry about these topic. These headings, capital allowance. Just write what you can memorize. right? What I mean, what you can understand, right? Um, can just say tax allowable depreciation computation and so forth. It's okay. All right. So um, you need to know the years now. Year 1, year 2, year 3. This is a 3-year investment. All right. So that's year 1. Year 1. The cost of the item was how much? The cost of the item, the machine, was 10,000. Okay, it was 10,000. All right. Generally, I love to put commas there for clarity. All right, and then we need to worry about, can come here and just say tax savings or benefit, tax savings. All right. Now the cost was 10,000, and the capital allowance at 25%. Remember, it's 25% reducing balance method. So at 25%, you come here and say equal sign, okay, this one multiply by 0.25. That's 2,500. Okay, then here our net book value, sorry, the net book value after the allowable depreciation, all right, is going to be 7,500. 7,500. Okay, that's the items. Uh, you might call it income tax value. Okay, you might call it income tax value, because remember, we are allowed by the taxman to determine the tax allowable depreciation using the rate of 25%, reducing balance method. So you may refer to that balance as the income tax value of the asset. It's fine, doesn't matter. In this case, it doesn't matter. Okay, but just to know that that's the remaining balance after we deduct the allowable depreciation. All right, but now we then need to go a step further. We then need to go a step further and determine the tax benefit. So for the tax benefit, we come here across and say, we then multiply the 2,500, this year's depreciation, multiply by, okay, multiply by 30%, because the tax rate is 30%. Okay, so multiply by the tax. Okay, this is too far. Let us put this tax savings a bit closer so that we don't confuse our brothers and sisters. Okay, so 2,500 multiplied by 30%, we get 750. This is now the tax saving. The tax saving. Okay, we have saved only $750 in the first year. Okay, let's move on. Year 2. Year 2. In year 2 now. In year 2, we know that the costs of the assets, I mean, the net book value from the, was at the start of year 2 was 7,500, and then we have to charge depreciation, I mean, the capital allowance on that 7,500, and that will be at 25% again. Remember, it's 25% on the reducing balance method. So capital allowance at 25%. So that's 25% of 7,500, and we must get our Okay, that's 25%, multiply by 7,500, that's 1,875. Okay, you then have to multiply this across by 30%, apply that by 30%, that's equals this amount multiplied by 30%, that's 562.50. Okay, then for us to get our net book value, the net book value, you underline here just to make your work easier. All right, so the net book value, that's 7,000 minus, that's this much minus this much, you get your 5,675. Okay, now we know that the project is going to end. Okay, the project is going to end in year 3. Okay, that's when the project is going to end. Okay, so we are going to dispose of this machine in year 3. Okay, for how much? We're going to dispose of this machine for 6,000. Okay, for 6,000. So our capital allowance benefits is only going to be based on the balancing charge. All right, so as the amount we are going to get is more than the amount I mean the net book value of the asset, then we are only going to have what is called a balancing charge. Okay, and in this case we are not going to enjoy any benefit. All right, there is no tax benefit that is going to accrue to us. It's a tax loss to us. All right, that's a tax loss, and we then have to underline. Okay, if you underline, get a balancing charge. Okay, which is the difference. The balancing charge is the difference here. That is this much minus this much. We've got 375, and this is where we have to, all right, just for so that you are not going to be confused, you can as well just continue to do, you can start with the NPV minus the proceeds, and you realize that you are having this profit, but the profit you are going to get, this 375, is actually we call it a balancing charge. It will lead to a tax loss, so it's not a tax saving but a tax loss. All right, so 30% you are going to have this. It's better for you to put this value in negative. All right, so 30% of 375 is going to be 113, which is negative. That's the tax benefit, loss we are talking about. It's not a saving. All right, now these are the cash flows which you need. Then you come to your mainstream. So this was actually a working. You can call it working number 1 or working number 2. All right, it was actually a working. Now you can then come to your NPV template. Okay, you come here and say cash flow computations. All right, can as well try to bolden it up. All right, and then you start as usual with your year 1, year 2, year 0, year 1, year 2, year 3. You can put your year 4. It doesn't matter. Sometimes because of these taxations, remember the tax here is paid in arrears, so obviously year 4 is going to be required. All right, and then from the question, we're given the operating cash flow, net operating cash flows of 5,000 during the first year, 7,000 during the second, and 8,000 during the third. So 578. So you come here and say operating flows. Year 1, we've got 5,000. Year 2, 7,000. Year 3, 8,000. Okay. Then the tax on operating flows. Okay, tax on operating flows. You can do the computations here on Excel. The examiners will see the formulas. So the tax rate from the question is 30%. As you know, we've been using 30% there. That's 30%. So it is paid in arrears. So for the tax for year 1 is going to be paid in year 2. So we are going to say equal sign 30% multiplied by this amount, and you get your 1,500. But remember, this 1,500 is negative. Okay, so you can just start your computation and say equal sign 30%. Sorry for that, my computer sometimes. All right, 30% multiplied by negative this much. That's 1,500 negative, and you can as well complete the computations there. All right, Excel has done it for you. Then for the text that's done, we then move on to the initial investment. In this case, was it a machine or a plant? You consult the question. It's a machine, so you can just say machine investment or initial investment. Machine cost. The machine cost. Okay, let us try to right, because if you don't enlarge those cells, we are going to have problems. Okay, how much was the machine it cost? Machine of 10,000. Okay, so that's 10,000. All right. Fine. I'm not happy with the formatting here, so I come here and try to do the formatting so that my figures look nice. It's okay, but there are no marks for that, so be careful in the exam. If you don't have time, don't worry about anything like that. Okay, then disposal, that is the scrap value of the machine. We are going to get 6,000 at the end of the period. Okay, remember the period ends in year 3, so don't make a mistake of putting this figure in year 4. Okay, and you then have to consider the tax savings. The tax savings on capital allowances. now sticking now. See, I'm sorry guys, proof on my capital investment for computers. All right, yeah, it's misbehaving now. It shows that the battery is about to die. I hope I'll finish, or as you can see the battery there. I'm not connected, I don't have power, the power problem. I hope I'll finish this video. Just pray. Okay, this one, it's a capital letter A there. Okay, tax savings, and we did these computations. We did these computations here. The first one is 750, then 5625.5, then 113 negative. So, but what is important is it is paid in arrears, so therefore we are going to start these savings in year 2. So the 750 is going to start to be enjoyed. It's a positive figure. Remember, it's a saving. Okay, a saving is a positive figure, so 750 in year 2. All right, and 562, you can just call it 563, and then in year 4 you're going to have negative 113. Okay, this is why I said this was not a tax benefit but a tax loss. All right, and then we move on to the working capital section. Working capital, we are told by the question that the working capital is going to be required, but at what rate? What's going on? Oh man, the working capital. Okay, working capital. Additional working capital will be required at the start of the project of $1,000. So at the start of the project, that is in year 0. So working capital $1,000. Remember, this initial 10,000 is a negative. Okay, should be negative figure. All right, then you move on. You have to know that this amount of 1,000 is going to be recovered as a positive figure in year 3. Okay, then you are done with the working capital. Then you come to the net cash flows. Net cash flows, and this part is the interesting one. Okay, you can't afford to miss this part or to fail it. Can as well sorry, because of this power thing, my machine is just becoming impossible. Anyway, doesn't matter. Here, that's the sum in brackets. Just you can just from this point to that's a negative 11,000. Okay, that's a negative 11,000. Right, and then you try to drag we should get how much there. What's going on? Okay, didn't pick this figure. Why? Right, it's fine. Cosine is much, right? Right, and cosine sum is much. How come it can't complete the sections? I hope now everything is now sorted. Okay, Then we move on to, because we are given the cost of capital there, so discount factor at what rate? What is the rate from the question? The question is saying 10%, so at 10%, right? Discount factors at 10%. We can use our tables. Okay, can use our tables. From the tables we can just compute that using our Excel spreadsheet. So for year one, we know that year one is 1. Okay, for year two, that's equal sign 1 over 1.1 to the power 1. Okay, that's 0.9, and here for year two, that's 1 over 1.1 to the power 2. What's going on? Okay, let us put brackets. Oh, I didn't put the equal sign. That could be the problem. Yes. All right. And here equal sign again, 1 over 1.1 to the power 3. All right. And here again, 1 over 1.1 to the power 4. Okay. Then the NPV part. This is your NPV. All right. I mean, this is your PV. Your PVs. This is going to be equal sum, open bracket. All right, and let us try to drag it out. Sorry guys, equal sign this much multiplied by this much. Okay, then we have to drag and see what's going on. Yes, those are our figures. All right, and then we can safely try to do some formatting, some underlining, because if you continue going on and on, you might end up mixing things. Oh yes. All right, and here you can as well underline. I'm sure this computer is going to allow me to finish. Okay, so now you have determined the PVs, and then you have to determine the NPV. The NPV now, the NPV is just going to be the addition. You just have to add across. So NPV, your NPV is going to be equal sign sum this much across, enter. So that's $7,109 dollars. Okay, that should be the NPV. Okay, if you add across, you should come to that value. So as the NPV is positive, therefore accept the project. That's it, ladies and gentlemen, and I hope you have benefited from this. In the next video that is coming, we need to talk of inflation. Okay, inflation and how to treat inflation in our NPV computations. Until then, may you continue to feel excited. I mean, very, very excited. I am signing out. Thank you.